Hello everyone and welcome to today's Mondac webinar in association with Pavestones, where you will hear from industry experts sharing their insights into the Nigerian and United States regulatory terrain for FinTechs from the perspective of compliance and funding. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. Shion Timi Koliulu is the managing partner and co-founder of Pavestones. Her practice experience spans across technology, foreign investments, data protection, and corporate and commercial law. She is recognized as a highly skilled, commercially minded lawyer who is able to balance her passion for excellence with her desire to ensure clients achieve their commercial goals. She has a strong strategic thinking skills, which she utilizes to positively impact the growth of businesses. Aderonke Alex Adedipe has extensive experience advising local and foreign financial institutions on trade finance, reserve-based lending, business formation, corporate structures, investment incentives, immigration, asset acquisitions, and other project finance transactions, which cut across various sectors, both local and foreign. And completing today's panel is Gary Ross. Gary has extensive experience representing small to large cap companies in public securities offerings, including initial public offerings of common equity, follow-on common stock offerings, preferred stock offerings, offerings of convertible and exchangeable securities, and offerings of senior and subordinated debt securities. He also regularly counsels private companies and investors in structuring private venture capital investment, including cross-border investments. Now, before I hand over to the panel, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page. They will endeavour to answer as many questions as possible during our Q&A and throughout, but please do reach out after the webinar for any other additional information you may require. It's now my pleasure to hand you over to Shion, Aderonke and Gary to begin. Thank you.
Thank you. Good afternoon, everyone. My name is Aderonke Alex Adedipe, and I am a partner and co-founder at Pavestones based in Lagos, Nigeria. Very briefly, before we delve into today's discussions, I think it's important that we understand why we chose to discuss this subject. And it's primarily because the world as we know it today is a global village. And as lawyers, we continue to experience and participate in cross-border transactions. And for this reason, it becomes imperative that we understand the regulatory framework as it applies to FinTech across various jurisdictions. And so today, I would have Shion and Gary, who would each have a presentation about the regulatory environment for FinTechs in Nigeria and the US, after which we would have a brief panel discussion and take questions from the audience. So please, Shion, over to you.
Thank you, Aderonke. Okay, so today I'm going to talk you through in a few minutes the regulatory requirements for FinTech in Nigeria. Next slide. As Aderonke has said, she is a co-founder with me at Pavestones Legal. Pavestones Legal is a full-service law practice, female-led law practice, with particular interest in technology and innovation, and also foreign direct investments. We have supported clients all over the world in operating in Nigeria successfully. Our clients are from Estonia, Malta, England, US, Hong Kong, and many more countries, South Africa, and many more countries. We are also a licensed data protection organization. Next slide, please. Today's presentation, with this presentation, I'm going to try to help you understand the growth of FinTech in Nigeria, the key FinTech licenses and regulations, and the regulatory challenges, and the best way to navigate them. Next. I am very aware that our audience today are from various countries. So just in case anyone had missed that, Nigeria is right there on the map, West Africa, And then since Gary will be talking about the US, I thought it would be good to also point out where the US is, but I'm sure everyone knows. Now, so Nigeria is the giant of Africa, at least is known as the giant of Africa. We have over 211 million people. It's the largest economy in Africa right now. The IMF has predicted that this year our GDP will be about $547 billion. We have over 500 tribes and languages. The main languages are Hausa, Yoruba, and Igbo. However, the official language in Nigeria is English, and our currency is Naira. Next, please. How did FinTech evolve in Nigeria? I think before we go into it, it'll be good for you to understand that. So FinTech and a lot of the other startups and tech companies evolved from the introduction of telecommunications in Nigeria and the penetration of the mobile phone. With telcos came data, internet connectivity, and hope for the people who could see that they could solve key financial problems amongst other problems with the use of data, a mobile phone. Things could change. There were frictions in the financial sector already. To transfer money, you had to go to a bank and queue for a long time. Non-existent credit facility, really difficult credit facilities. International trade, difficult to achieve because remittance was hard. Now, the crop of people who are now known as FinTechs in Nigeria saw the issue and wanted to solve it, and solved it with data and mobile phones. There was also a large unbanked population, and that is still something that is being solved with FinTechs. Next slide, please. In Nigeria, and I believe in most countries, FinTechs are categorized, can be categorized like this. So we have digital banking. In Nigeria, we have Wema Alert, Kuda Bank, amongst others. And what they are doing is providing banking services predominantly online, and making it easier and for people to access financial services. There's digital payment. One of the most popular FinTechs we have in Nigeria is in that space, Flutterwave, and then we have Paystack and the rest. And they're making it easier for people to transact online and receive payments online. Remittance, international money transfer, is another FinTech sector category. We have Nairagram, MoneyGram, and the rest, making it easy for people to transfer money out of Nigeria and into Nigeria and transact, improving international trade. Lending, such a big deal because that has been a restriction for many. Credit facility, the non-existence of credit in Nigeria has kind of made trade difficult. So a lot of FinTechs have seen this issue, and we've had international FinTechs and local ones come in the country to solve the problem. I know more developed other countries, it's easy for them. We have wealth management and digital assets and blockchain, so cryptocurrency and blockchain. And then there are others, but I will stop here. So next slide, please. Our regulators. To understand the licensing regime, it's important for you to understand our regulators, or to know who the regulators are. In general, every FinTech company is first a company, and every company is regulated by the Corporate Affairs Commission in Nigeria. You need to incorporate to carry on business in Nigeria, file annual returns. All changes to the company structure is done at the Corporate Affairs Commission. We also have the Nigeria Data Protection Bureau. Data protection is a bit new in Nigeria, but it developed, I believe our government recognized the importance of that, especially as startups grew and technology became prevalent in Nigeria. So we have the Nigeria Data Protection Bureau requiring people who are dealing with data of Nigerians, over 1,000 Nigerian data, to be audited, and also requiring all companies to ensure that they are managing data with the best data protection practices. There's a Federal Competition Consumer Protection Commission Recently, they've become more relevant in the fintech space because they now require all digital lending companies to register with them. So they're very relevant. They're trying to protect consumers against unscrupulous practices by digital lenders and trying to regulate that space. We have general, federal, and state laws. And then more specifically for the fintech space, there's the Central Bank of Nigeria. The central bank has really tried to play catch up with innovation. A challenge for regulators when the startups Nigeria. There's the Securities and Exchange Commission and the National Insurance Commission. So Securities and Exchange Commission, trading on the stock exchange, virtual assets, cryptocurrency, they regulate that. So next slide, please. Now, the licenses. As I said earlier, our regulators had to play catch up with the startups and the evolution going on, the innovation that had begun in Nigeria. And this meant that when the startups first started and the fintechs first started working in Nigeria or started providing services, we didn't exactly have regulations that were designed for it. So most of us lawyers had to help the fintechs find the regulations, existing regulations that they could fit into. Now, one of these existing regulations was the microfinance bank regulation. And this was useful for any fintech that wanted to provide digital banking services. Now, with the microfinance bank license, fintechs are able to receive deposits, give loans to a certain extent, open accounts, issue cards. This license and microfinance bank license is still one of the most predominant licenses being used today by fintechs to provide digital banking services. For the Unit 1, so we have the licenses we have in different buckets. There's the Unit 1 license, state license, and the national license. As the name suggests, the unit license is a bit smaller. With unit tier 1, it's tied to physical locations. So the fintech is expected to have 5 branches in an urban area, and branches as a physical location. Now, or are permitted to have up to 5. Now, the tier 2, 2 branches in a rural area. Now, what makes it not really, the branch requirement not really important to fintechs is because half the time the services are done online. So whether or not, most fintechs will have like one location, physical location, and then provide their services online to a wide range of consumers. And it's been hard for the regulators to track exactly where these people are. So you find that a lot of the fintechs are using the lowest license. Now the unit license. Now the capital requirement for the unit license ranges from about 50 million if it's a tier 2 license, unit license, and then the tier 1 unit license 200 million. Then the state license, and that's in Naira. So the dollar equivalent is stated there, about $434,000 for the tier 1, $108,000 for the tier 2. The state license, which allows the fintech provide services in one state and is tied also to physical location, is the capital requirement is about $2.2 million. And then the national license allows fintechs provide services all over in various states, and the capital requirement is about $12 million. But as I said, because most of the services are provided online, it's you find that most of the fintechs don't go for the national, they go for the list of the license categories. Now, another one that has been used for digital banking services in Nigeria is the Payment Service Bank license. But this is limited to only the companies that can access or obtain a Payment Service Bank license are like telcos, FinTechs, retail chains, and this license was created to deal with the issue of the unbanked, the large number of people who are unbanked, to encourage financial inclusion. The capital requirement for this is about $10 million. And with this license, you can receive deposits, open a bank account can be opened, cards can be issued. Limited sale of FX is permitted with this license. However, the Payment Service Bank license holders are not permitted to give loans. Then there's the Mobile Money Operators license. And with mobile money, fintechs that accept money in a digital wallet, e-money, issue e-money, digital wallet services are encouraged to use this license. And the minimum capital is about $4.3 million to have this license. Limitation to this is that lending is not permitted and FX transactions. With the mobile money operator license, you can have bank-led or non-bank-led services. Please, next slide. Now, as I said earlier, some of our most popular fintechs from Nigeria are in this segment, payment service providers. So with this license, you can get a payment solution service provider license, which allows for payment processing gateways, payment aggregation, like what Flutterwave and Paystack does. You can get a payment terminal service provider license, which allows for POS terminal operations. And you can get a switching and processing license. With the switching license, you can do everything the PSSP and the PTSP can do. Now, the capital requirement is stated here. So for the PSSP, the minimum capital requirement is about $2,700, depending on the exchange rate. And the PTSP, $217,000 for the PSSP. The PTSP, $217,000, and then the switching and processing license requires about $4.3 million as capital to get that license. Next slide, please. Lending, credit services. As I said earlier, there's a huge gap in the Nigerian market here. A lot of other countries, credit is easily available. It's almost forced on you. Here, it's a privilege to get credit facilities. So the fintechs have seen the issue here, and they're trying to solve that. The kind of license that you can get for this service is you can use a finance company license, but you need a minimum capital of $217,000 or 100 million naira. With the finance company license, you can lend, finance projects, manage funds, but you can't accept deposits. Then the lowest barrier entry license, the license which provides that is the easiest to enter the market with, is the money lender's license. A lot of the digital lending providers use a money lender's license, but it's a state-bound license. So there's a Lagos State money lender's license, and then money lender's license per state. This license, the capital required is about $43,000. And permissible activity lending, but you can't accept deposits, and CBN doesn't back debt recovery. And regulating this sector, those with money lenders license, has been a challenge, and that's why the FCCPC now requires fintechs to register with them so they can oversee how they are chasing after funds, repayment of funds. Okay, next slide, please. Regulatory challenges and how to navigate them. Please, next slide. Okay, so if you're functioning in the Nigerian market, or if you intend to enter into the Nigerian market and provide fintech services, you should know that you should note some of this as possible challenges, but there are ways to manage it. So one of it is lack of clarity in like regulations, especially given that fintechs are innovating, and sometimes the regulations have not caught up with what they are doing. And so the regulators sometimes try to fit people in a box, that existing box of regulations. It's usually advisable that you get a lawyer or an advisor who can help you navigate this and understand the compliance requirements, your compliance requirements, so you don't fall foul of the regulatory requirements. Compliance cost also, as I said earlier, or as you saw from my last slides, the capital requirements can be a bit, and startups, being that they are startups, sometimes don't have the funds for that to meet the requirements. So that can be a challenge, but I guess that's why a lot of startups have been able to get access to investors who believe in what they're trying to achieve in Nigeria. Multiple license requirements. Sometimes we have clients that want to do they want to improve the system by doing multiple things at once. Payment gateway services, receive deposit, give loans. But you find that our licenses are in buckets. So there's the one for lending, and then there's the one for payment gateway services. So a lot of this, we have to advise these clients that they will need to get different licenses, and therefore the cost is more expensive to achieve that. But I think CBN is trying to streamline, and there are certain guidelines, drafts that are being looked at right now, perhaps to improve this, but it might take some time. And then some regulations restrict completely what the fintechs are trying to do, like cryptocurrency. I'm sure a lot of people know that in Nigeria, the CBN has said banks, financial institutions are not to work with, are not to accept funds from cryptocurrency service providers. And that kind of has been a hurdle to anyone in that space trying to provide that service. Next slide, please. So as I said earlier, to manage these challenges, it's good to engage the regulators, and you can get lawyers to speak to your regulators and understand what their requirements are. It's good to stay up to date and agile with understand what the regulations are and the compliance requirements for what you're doing. You can also use technology to track compliance. What we do for a lot of our clients is we put all the compliance requirements in an Excel sheet and try to help them track it and know when they're due, what is due, so that they meet them and they don't fall foul of that requirement. And as I said, engage experts who can help you. So next slide. So that's it from me for now. Short time, but thank you for listening.
Great. Thank you very much for that wonderful presentation. So I would invite Gary to please go over his slides, after which we'll have a very quick discussion. So Gary, you have about 15 minutes. So please go ahead.
Sure, and I'm not sure that I'm going to need 15 minutes. I think most people are here for the Pavestones part, and I'd really like to thank the Pavestones folks. So we've worked with them before, always had a good working relationship, and we have a lot of admiration for the folks at Pavestones, and we really appreciate being a part of this presentation today. Next slide, please. I won't state much about the law firm Ross Law Group. You can look us up, rosslawgroup.co. I'll note we're in Times Square, and today there's a buzzing sound on the street outside, so I apologize in advance if the microphone is picking some of that up, and sometimes there's sirens and the like, so I'll apologize in advance for the normal kind of Times Square noise that's out there. They don't always give us advance notice when there's going to be noise on the street. We do a lot of cross-border transactions. We do a lot with Nigeria, a lot with West Africa in general, also some some with East Africa and India and other places around the world. So if you are looking for U.S. legal representation for a cross-border transaction, then please keep us in mind. Next slide, please. A lot of people have a Delaware C Corp because of fundraising concerns, because there's a lot of venture capital funds, both in Silicon Valley and around the world, sometimes in the UK and elsewhere, that will only invest in Delaware corporations. So I want to start off just talking about the fundraising. It's not all I'm going to talk about today, but it's a lot of what I'm going to talk about today is fundraising concerns. And I'll start with talking about Regulation S, because a lot of people feel like, oh, if I have a Delaware corporation, does that mean I can only accept investors from the United States? Does that mean all investors have to be accredited, even like my neighbor here in Lagos, or someone in Ghana or somewhere like that? But in general, no. Non-U.S. investors can go into your company, whether it's a Delaware C Corp or anything else, through something called Regulation S. And Regulation S basically says, it's basically the U.S. Securities and Exchange Commission saying, hey, we're only regulating the United States. So Regulation S is offshore, non-U.S. investors. In general, for the things I'm going to talk about today, the U.S. regulators are most concerned with U.S. consumers and investors. So they're not as concerned with kind of people being here or having a Delaware corporation or the like. So they really get involved once they're U.S. investors. So I just want to lead with that if you have a Delaware corporation, it doesn't mean that you're going to have trouble getting investors from your countrymen and wherever you are. In general, they can go in through Regulation S without any restrictions. To the U.S. securities laws. So the primary U.S. securities laws kind of underpinning everything is the U.S. Securities Act of 1933. A lot of people are like, hey, 1933, that was a long time ago. Is that still relevant today? But really, all they did in 1933 was basically set out a table of contents, like just kind of a brief outline. And then since then, in the last 90 years or so, there's been a lot of filling in. So a lot of the regulations and the like, don't necessarily date from 1933. They're much more recent than that. Under the Securities Act, Section 5 of the Securities Act requires all securities sold in the U.S. to U.S. persons to be either registered or exempt from registration pursuant to two other sections, Section 3 or 4. Section 3 deals with exempt securities such as municipalities and the like. A lot of municipalities, City of Chicago or something, will issue bonds and the like. Those don't have to be registered under the Securities Act. And then Section 4 is where we spend the most time on, particularly Section 4A2, and that deals with exempt transactions of securities. Section 4A2, it exempts transactions that don't involve any public offering or distribution. And this is where the accredited investor definition comes in. So there's two primary safe harbors under Section 4A2. They are under something called Regulation D. So there's a lot of kind of jargon that I'm throwing out at you. It's not terribly important, but the takeaway is that there are exemptions for private placements. Section 4A2 is under Securities Act. Under that is Regulation D. And under Regulation D, there's Rule 506B as in boy and Rule 506C as in cricket. Rule 506B allows for unlimited sales to an unlimited number of investors as long as all investors are accredited. There is a kind of a cushion allowing you to have 35 non-accredited investors, but don't pay attention to that, because once you have even one non-accredited investor, all these really burdensome information requirements kick in. So we always tell people, hey, don't have any non-accredited investors. It's really not worth it. And for 506B, there's no general solicitation required. So you can have a website maybe, but you can't have kind of solicitation to investors and the like. It really has to be private, word of mouth things people you already know and have a pre-existing relationship with. The flip side of that is 506C. 506C, you can use general solicitation, you can use the internet, you can use radio, TV, whatever you like, but with 506C, you have to actively verify everyone as an accredited investor. Even if it's Bill Gates or Warren Buffett, you got to see tax returns or whatnot, or send them to a third party to verify accredited investor status. Whereas with 506B, as long as you don't have any reason to doubt that a person is an accredited investor, then they can fill out an investor questionnaire, verifying that they're an accredited investor, and you're okay on that. So those are the takeaways to keep in mind. Regulation S, so people outside the US are generally not going to have to come in under Rule 506B or 506C. And then Rule 506B, no general solicitation, but you don't have to actively verify as long as they fill out a questionnaire and state that they're a accredited investor, and you don't have any reason to doubt that. And then 506C, you can use general solicitation, but you have to actively verify accredited investor. Next slide, please. I'll talk about the accredited investor status because people are always interested in it. This is the slide for individuals. The next slide is going to talk about entities. These are not all the items, but these are the ones that I think are most relevant today. It got tweaked a little bit 2.5 years ago. The one that people are most familiar with is the financial criteria here at the top. Net worth of over 1 million, either individually or with spouse or partner, but you have to exclude the house. And income over $200,000 individually or $300,000 with spouse or partner in each of the prior 2 years, and they have to reasonably expect the same for the current year. And there's a way that that question needs to be asked. They have to actually certify or verify that they expect to have $300,000 for this current year. Now, sometimes we get asked, what if they invest, today, April 19th, and then tomorrow, April 20th, they lose their job and they don't wind up making it this year? And that doesn't really matter. It's not an ongoing thing where they have to be an accredited investor for the rest of their life. What matters is when they make the investment into the company, when they sign the subscription agreement. There's also professional criteria if folks don't meet the financial criteria. If you're a director or executive officer of the company selling the security, not if you're just a director and officer in general of just any company ever. But if your company is issuing the security, then you don't have to make $200,000 a year or be worth $1 million. If you're the CFO or something like that, it can't be a lower level administrative position. But if you're officer or director or something, you can invest in your company's securities. Also, people who hold certain licenses from FINRA. Series 7 is a popular one for brokers, Series 65, Series 82, and then there's some other things, family client and family office. Next slide, please. For entities, so entities who have investments in excess of $5 million, not that you plan on having investments of $5 million, but that you already have investments of $5 million. Also, any corporation or partnership, limited liability company, trust, all these other things, basically any entity that has that meets that threshold, that has assets over $5 million, an entity where all the equity owners are accredited investors. This happens a lot. People will form an LLC in order to make an investment, and the LLC will be brand new. The LLC will have 0 assets, and the question will arise, well, is that an accredited investor? It is, as long as the people forming the LLC are accredited investors. So if you got 10 people and 9 are accredited and 1 is not, that 1 needs to maybe sit this one out until they can meet the accredited investor threshold, or there's some other things we can do. But in general, that 1 person should not be a part of the LLC because it's going to affect the accredited investor status. Also, certain financial entities, banks, savings and loan institution, you can't just kind of slap a sign up saying, hey, I'm a small business investment company. There are certain criteria for that and licenses. But if you have the license and the like, then your entity is an accredited investor and can make investments that are not registered under the Securities Act. So if an offering is registered under the Securities Act, next slide, please. If it is registered under the Securities Act, then there aren't those restrictions. So an initial public offering, typically we're talking about an initial public offering of common stock, but it's not always that. It can be a fund offering partnership interest or the like. If you're registered under the Securities Act in general, you don't need to worry about these exemptions, don't need to worry about limiting it to accredited investors. One thing I'll mention before I go into IPOs and crowdfunding is that actually listing on NASDAQ and New York Stock Exchange is a separate process. It is done in concert with registering under the Securities Act. With registering under the Securities Act in an initial public offering, we're filling out something called a Form S-1, which requires a lot of information about the company, the history of the company, what the company sees as the prominent risk that investors are taking on by investing, who the management is, who the executive officers are, new products and the like that they foresee. There's certain tax and securities law disclosures that have to be made in that. And we file it with the SEC, and then the SEC gives comments, and there's a lot of back and forth. It is a time-consuming process. Usually it takes about 8 months or so. It also requires audited financials. And a lot of times people are spending a lot more on the audit than they are on legal costs or anything else. You know, they might be spending just as much on marketing, but usually getting something audited is a major expense, even if it's a newer company, but especially if it's an older company. Usually you only need the last 2 years audited if you're doing an initial public offering. I'll also talk about regulation crowdfunding. For regulation crowdfunding, you have to have a U.S. entity. For initial public offering, you don't. And for these transactions I was talking about, 506B and 506C, you don't have to have a U.S. entity for those. So we primarily work with U.S. entities, but not always. Sometimes, you know, it's Mauritius or somewhere else, Channel Islands. But for regulation crowdfunding, you have to have a U.S. entity. It doesn't have to be Delaware, but it has to be a U.S. entity. For regulation crowdfunding, it is a public offering. You don't have to go through the burdensome requirements of the Form S1 that is used with an IPO. It's a Form C, which is much less information required, though there is information required, and it is filed publicly. Unlike with Regulation D and Rule 506B and 506C, there the only public filing is something called a Form D, which is a very simple, straightforward 4-page filing where you're saying how much is raised, how much they want raised, the directors of the company, if a broker-dealer is used, if any of the proceeds are going to the management of the company. So it's not much information. I think it's 15 boxes that we fill out, whereas a Form S1, I mean, that can be 70 pages. Form C for regulation crowdfunding is usually about 25 pages or something like that. Regulation crowdfunding, you can raise up to $5 million. The investors don't have to be in the US. One issue people don't appreciate always, because we always get the question, well, if I'm doing an IPO or regulation crowdfunding, can we accept, you know, investors in France or Germany or wherever? And with US law, you can, but that doesn't mean that the person is complying with their own law in France or Germany. You know, what really matters is where the investor is, not just for US purposes, but around the world. Most countries want to take care of their own. So I always have to caveat things that, yes, with your US offering, you can accept non-US people, but you know, those people, you should make sure that those people are complying with the laws of their home jurisdiction. Next slide, please. For FinTech businesses, so FinTech businesses, if you don't want to operate in the US and you have a FinTech business in Nigeria or elsewhere, and you just have a Delaware C Corp and you have no interest in operating in the US, then usually you don't have to get any kind of license or anything like that. Usually you are okay to operate. You can have your Delaware C Corp and you can have your licenses in Nigeria or elsewhere, and you don't have to get anything licensed at the Delaware C Corp level. So it's really only when people get ambitious and they're like, okay, we have this Delaware C Corp and we have a successful money transmission business in Nigeria, and now we want to branch out to the US. At that point, you're subject to various regulations and you might need certain licenses and the like. FinTech companies are very highly regulated. Anything with financial institutions and the like is very highly regulated in the US. I'm going to just kind of list some of the prominent regulators here in the US. I'm not going to go as much in detail as Sean did on hers. I'm just going to really list them out just so you can hear like the regulators here. There's the Consumer Financial Protection Bureau, which handles lending practices, making sure that it's fair lending and the like. People aren't taking advantage of elderly folks or whoever. The Federal Deposit Insurance Corporation handles consumer protection and also insurance of deposits. So we've heard a bit about them lately here in the US with Silicon Valley Bank and Signature Bank and some others that were taken over by the FDIC. The SEC, which I've talked about, it along with FINRA regulates broker-dealers and investment advisors, stock exchanges, and then people issuing securities. The Federal Trade Commission regulates, it protects consumers from unfair practices, so false advertising and the like. Hey, this lawn chair will cure your backache or something like that. If you're making kind of crazy claims, the FTC might be involved. Commodities Futures Trading Commission does future trading markets and exchanges, and then Financial Crimes Enforcement Network handles anti-money laundering. I'll talk real quick about privacy laws. collection, use, and sharing of personal data is regulated, and that's even no matter where a company is located. If they're getting information from the U.S. people, from folks in the U.S., then U.S. laws are going to kick in. And there's two primary ones to keep in mind: the California Consumer Privacy Act. I know it says California, and it's really just for California, but it's hard to do anything in the U.S. without every state being implicated. And a lot of states have modeled their own privacy laws on the California one, and it talks about how to collect data and really how to safeguard that, because we don't want hackers being able to spill data, people's personal data all over the place. The Gramm-Leach-Bliley Act is most important for FinTechs because it covers financial institutions. And then if you have any kind of health, health tech or anything like that, I know this is based on FinTech, but health tech is going to be covered by HIPAA, the Health Insurance Portability and Accountability Act. One thing I'll mention before we go on to the next slide is that here in the U.S., we typically don't restrict transfers of data abroad. I know that a lot of jurisdictions do, so we have all these rules regarding collection of data here in the U.S., but in terms of transferring them, we usually don't have restrictions on that. Next slide, please. This is just a little about banking. I'll talk a little bit. The Office of Comptroller of the Currency, they do national bank licenses. So if you have a bank in Nigeria and you have a Delaware C corporation, then as at the end there, you don't need to follow Title V. You don't need anything here. But the minute you decide that you do want to do banking here, you need to either get a national banking charter from the Office of Comptroller of the Currency or a state banking charter from your state institution. And here we have Delaware bank regulations in case somebody wants to, is interested in that. The difference between the two is really the obligations and also the resources that are available. If you're at the federal level, and usually you have more resources available for, lending from the federal government and the like, or borrowing money from the federal government. Next slide, please. I'm going to wrap things up just here with Committee on Foreign Investment, because we get a lot of questions about CFIUS. What is CFIUS? And it really just came into prominence just a couple of years ago. So it's been around for a while, but it's really just been in the last couple of years. CFIUS reviews certain investments in the U.S. from non-U.S. persons. So it's not from U.S. outwards, which is normally what we're dealing with, U.S. investors investing into, into Nigeria and other places. But this deals with non-U.S. persons taking on, which could happen if there's a Delaware C Corp that's being bought by a non-U.S. company, not Delaware C Corp, but something else. Then it could implicate CFIUS. In general, the concern is non-U.S. control of a U.S. business that has some national security interest. So usually this is going to be something, it could be military technology related. That's where we get into, that's where it's implicated the most. Not necessarily, building bombs or anything, but some kind of technology that can be used for warfare. And then that's when it's something that we have to pay attention to. You can get pre-clearance for CFIUS, and you don't have to, but it's always better to if it's for some reason a prominent transaction or it involves a particularly thorny technology. And with that, that's it. So I'm really looking forward to your questions, and thank you again to Pavestones and the good folks at Mondac.
Thank you, Gary. Thank you again, Sheung. So we do have a number of questions from the audience, but I would like us to use the next 10 minutes, just take the next 10 minutes to answer a few questions which I have called from each of your presentations. So Sheung, I would start with you. Sheung, so while I understand from your presentation that there are different regulatory requirements for fintech businesses, and obviously the applicable regulation would depend on the nature of the fintech subsector or perhaps the nature of the business in which you're operating. As a lawyer myself, I think that it is typical for foreigners to ask questions around whether you're required to have a physical presence in Nigeria, for example, or whether directors must be present in Nigeria, or whether they must be citizens in order for them to operate a fintech company or a financial institution in Nigeria. So can you please just shed some more light about some local content requirements or foreign participation in the Nigerian fintech space?
Okay, thank you, Ronke. That's a good question. Yes, so if you want to carry on business in Nigeria, you're expected to incorporate a company in Nigeria and carry on the business through that company incorporated in Nigeria. With respect to local content requirements, the Nigerian Investment Promotion Council Act actually encourages or permits 100% foreign ownership of companies, except of most companies, except some in certain sectors like ammunition, weapons, and the rest. And then there are some sectors that are very specific, like oil and gas. The oil and gas sector requires Nigerians to have been involved in the setup, to be shareholders and directors in the company. Now, with respect to fintech, although there isn't any clear statement out there saying that you must have a Nigerian director or a Nigerian shareholder, and therefore you can be 100% foreign owned. In practice, it's advisable that the fintechs, whether they have been established by a foreign company or not, ensure that they have local Nigerians in the business as shareholders and directors. And this is because, especially the financial sector, the companies that flourish in the financial sector flourish with relationships also. It's good to have a Nigerian who understands the culture, who can relate with the regulators. And yeah, so it's just good practice to have Nigerians as shareholders and directors. And if there's a technology transfer relationship between a parent company and a subsidiary in Nigeria to provide the fintech services, you're going to need an approval from NOTAB, and the NOTAB regulator likes to see that there's some transfer, some local content in the company. So in general, it's good advice. It's good practice to have Nigerians. Thanks.
Okay, thank you, Sheil. And talking about NOTAB, that takes me to the next question, which is, so for every business, right, there's an ultimate goal, and the ultimate goal is to make profits. That's the bottom line. And for foreigners who have invested funds in an entirely foreign terrain, they want some guarantee that they can take away their investments alongside profits back to their home country. Now, I know that generally Nigeria does not have exchange control regulations, but we also know that in reality, and very recently, there has been scarcity of foreign exchange within the official market. How would you advise foreign investors to address this concern of repatriation? Because I think this is a very burning issue for most investors who are already here and who potentially want to come into Nigeria.
Okay. So firstly, at the minimum, any foreign company that wants to do business in Nigeria should inflow the capital for the business through what we call an authorized dealer, a bank, a registered bank. Now, the funds should be inflowed either as structured as an equity investment in the business or a loan, or can be both. But when you inflow your capital for your business in Nigeria in that way, you get what we call a certificate of capital importation from the banks, the authorized dealers. Now, a company that has what we call a CCI, certificate of capital importation, is then permitted to access the official forex markets, and that is at the point where they want to repatriate or transfer proceeds from the investment in Nigeria out of the country or capital, they can access it through the official forex market. Now, I did hear Aderonke say that there's scarcity. So that's another issue. But at the minimum, you want to ensure that you have your CCI, so at least you can go to the banks. However, sometimes the foreign exchange is not available, and then you might need to work with some international money transfer partners if it's not available to do some transfers. However, it's best you add, but when it's not even available at the bank, sometimes you can have a schedule with the bank for accessing forex. When they have it, they'll let you know. Now, apart from the CCI, it's also possible to structure the transfer of technology into Nigeria through a technology transfer agreement. We see a lot of clients do that. So if there's a parent company out of Nigeria already providing the service outside of Nigeria, and then they want to come into Nigeria and establish a subsidiary here, they can have a technology transfer agreement where the foreign parent company brings some technology know-how and trace the subsidiary so they can provide the services in Nigeria. Now, the subsidiary will then have to pay a fee to the parent company for that, for the transfer of technology. When they have that arrangement, that company must get what we call a NOTAP approval, National Acquisition and Technology Office. Anyway, the NOTAP approval. Now, that's a regulator that you have to go to when you have technology know-how and transfer agreements. When they approve the agreement, it also gives you access to the official foreign exchange markets to access FX to repatriate money out of the country. So in summary, my advice is ensure you get your CCI. If there's technology transfer, enter into the right agreement so you can also get your fees, your approval for the agreement and access the official foreign exchange market for that purpose also, to make payments to your parent company. And yeah, with relationships and partnerships, we found that clients are able to get around the FX scarcity. Thank you.
Thank you, Sheon. I see a lot of questions trooping in. So very quickly, I would go to Gary before I come back to you, Sheon. Gary, so in our experience, there are many VCs, especially in the US, who are investing in the Nigerian fintech markets. And just as you highlighted during your presentation, many of them often require the fintech startups in Nigeria to establish a holding structure in the US, specifically in jurisdictions like Delaware. And there's also the presumption that there are tax benefits which may either be overrated or not quite understood by the startups here in Nigeria. So there's a knowledge gap. Given your experience, having dealt in some of these cross-border transactions, what would you say are the very important legal considerations and implications for establishing a holdco, right, in the US, citing the Delaware example?
Sure. The first thing I'll mention is that there's no residency requirement. So you don't have to have US directors or US shareholders. So sometimes we get that question. I know a lot of jurisdictions, you have that shown, just touched on it for Nigeria, but here in the US, you can have all non-US directors and the like. In terms of tax benefits, I don't know if it's a benefit, but in general, having a corporation, it's not a pass-through. So somebody can invest in a corporation, whether they're inside the US or outside of the US, and they wouldn't be subject to the US income taxes. I mean, they have to pay tax on whatever dividends they're getting from the US corporation. But unlike with a US pass-through, so if you wanted to set up a US limited liability company as your parent company, which a lot of U.S. corporations would do, they'd have a holding company as an LLC. But if you're a non-U.S. company and you set up an LLC, you're going to have difficulty getting non-U.S. investments into that limited liability company, because it being a pass-through, the non-U.S. people who are investing are going to be subject to U.S. taxes, and they're going to have to file a U.S. tax return. So if you have a corporation, then the shareholders, they wouldn't have to file a U.S. tax return. You know, they owe taxes on any dividends, but they wouldn't have to have a 1040 tax return. I want to hit on a couple of other things for what we call the Delaware flip. So if somebody comes to us and they have a company in Nigeria and they want to have a U.S. parent company, it is better if you go to a U.S. law firm before you've done anything, before you form the Delaware corporation. Kind of the worst set of facts is when people come in, we form the Delaware corporation and we have a mirror of the shareholders. So we have 16 shareholders in the Nigerian level, and we have 16 the same 16 at the U.S. level. That's really difficult. Then you got to try to get rid of the U.S. shareholders at the Nigerian level. So it's much better if you can come to, you know, not necessarily Ross Law Group, but any U.S. law firm before you've done anything. We would set up a Delaware corporation and then do some kind of share exchange where people are exchanging their shares in the Nigerian company for the U.S. company. Because at the end of the day, you want all the shareholders to be at the U.S. level, and then that Nigerian company to only be owned by one investor, that U.S. corporation. Now, if you have something for some kind of license requirement, if you have to have a local owner, sometimes we get this. If licensing purposes, you have to have a local owner. Then normally we have a founder having one share of stock, and then that founder signs something like a representation agreement where they're holding that just as a representative of the Delaware C Corp. So the takeaway is that do not mirror the ownership in the two structures, because that's makes it a lot harder when we're doing the flip.
Okay, thank you very much, Gary. I have one last question for you, and I would appreciate if you could please answer this question in 1 minute 30 seconds so that we can go over the questions from the audience, because there's quite a number. So there's the Silicon Valley Bank, which has been all over the news of late. From summary of events, one of the causes of its downfall arose from the fact that majority of the customers' deposits were invested in treasury bonds. Using Nigeria as an analogy, I know that Central Bank of Nigeria has prudential guidelines for banks, which require them to maintain at least a minimum percentage of depositors' funds in the banks. Now, in the case of the Silicon Valley Bank, and based on the facts made available to the public, would you say that there are any clear rules or perhaps compliance issues that have been breached here? And if so, would you also say that there has been a lag in monitoring by the regulators, which may have prevented this downfall?
Well, I would say, so I taught bank regulations for a couple of years at a local law school, and I don't know of any bank regulations that they actually breached. It seems like they weren't using best practices though, because they had a lot of money in U.S. Treasury bonds that are long-term investments, and they were paying out an okay interest rate compared to a couple of years ago, but now the interest rates are a lot higher. They weren't paying as much as they were having to offer depositors, and they had all these tech companies as their customer base, their deposit base, who are a lot, you know, they're obviously very tech friendly and the like, and they can pull their deposits, you know, any sign of trouble and the like, you know, these companies can pull their deposits. So they had these short-term liabilities, and in the banking sector, loans are assets and deposits are liabilities. So they had short-term liabilities and they had really longer-term assets, and that's not a good mix, because all of a sudden you had everybody pulling their deposits and they had this huge liability thing. So really they were in trouble regardless. So, you know, if you have, for most bank regulations, you're not required to have a 100% coverage of whatever your depositors are. And, you know, anything short of that, there's always going to be a risk. And the risk was just pronounced with Silicon Valley Bank because of their depositor base.
Thank you. Thanks for providing that clarity, Gary. So I have quite a few questions, but in the interest of time, Seun, there are 2 questions regarding PSSP license, share capital requirements, which I believe may have been addressed in your presentation. However, I would invite the audience, please, perhaps after this After this session, direct your questions to each of the participants if your questions have not been answered. But Sheil, so I have a question from Adarugo, and her question is, are there any policy strategies being made to incorporate or ensure seamless integration of blockchain in the Nigerian fintech space?
Well, there is, okay, so the Investment and Securities, the Securities and Exchange Commission, there are some laws there that are regulating virtual assets and digital assets, but there isn't any one regulation right now for blockchain. We all know what's happening with cryptocurrency. There is some conflict right now with SEC regulation, which is trying to regulate virtual assets and digital assets, and then the CBN still not saying anything clearly permitting cryptocurrency. But if there isn't any clear, the long and short is there isn't one regulation right now for blockchain, but it's permitted. It just depends on what it's used for, because blockchain is the infrastructure by which the rest are built. Thanks.
Thank you. Okay, question for you, Gary. So Stella asks, what is the corporate registration structure for commencing a company in Delaware?
Yeah, sure. So what creates a Delaware corporation is a certificate of incorporation. And what that certificate of incorporation lays out is the number of shares that are being authorized for issuance. It doesn't actually issue any shares, but it authorizes the shares for issuance. So it's generally going to authorize common stock. When you get in and you start taking investors and they want preferred stock, then you're going to have to amend and restate that certificate of incorporation to also authorize preferred stock. And it also has certain housekeeping things like the registered address. In Delaware, you have to hire a registered agent, somebody who basically sits in Delaware and can accept process in case somebody sues your corporation. So it's a certificate of incorporation that starts the company, but there are some other things that you need. You also need bylaws. You need organizational resolutions that sets the fiscal year, goes ahead and elects officers. And you also need something called an action of sole incorporator that sets out the directors, the initial directors, and also usually brings about the bylaws. So those are the 4 documents that you really need: certificate of incorporation, action of sole incorporate, bylaws, and organizational resolutions. So even though the certificate of incorporation forms the corporation, you really need the other 3 too. So some people come and they just have one and they filed it 6 months ago. You really need to have all 4 from the beginning.
Thank you. Unfortunately, we would not be able to take any more questions. I have just been informed by the organizers that we now have to conclude this session. So thank you very much, Sheil. Thank you very much once again, Gary, for making this session very informative and very engaging. I appreciate each and every one of us who have participated. This now concludes our session.